overall, what I was saying is important day overall. The market, it finally reached the moving average on the daily chart, which is right here. And I thought, I mean, for one, as you know, I've been saying for a while that the market was probably going to test the moving average. And the reason for that is eventually, when the market has a strong rally and it's above the moving average for a lot of bars, that increases the probability. If the market continues to stay above the moving average, then eventually there's going to be not enough traders willing to pay a premium to keep the market above the moving average. Here, traders were happy to buy above the average price right here. And then we got an upside breakout here. But at this point, we were well over 20 bars without touching the blue line, the moving average. And I thought December 20th was really important bar. It was a big enough surprise that the chances are the market was probably going to go mostly sideways. Now, why does that matter? Why does that matter? The reason it matters is because it's this bar I thought made the market a trading range. And because of that, even if we went to a new high, I thought the chances were pretty good that there'd be sellers above and we'd get a second leg down and a test of the moving average. And we'd probably test the December 20th close right here. So this is December 20th. So we've accomplished both of those things. We have a bear breakout and we're at the moving average. The bears, they need follow through selling below the moving average. Otherwise, this will probably just be a trading range. So right now, the bears have not done enough. So what do I expect tomorrow? Probably disappointment for the bulls. We'll take a look at the euro versus the dollar. Euro versus the dollar. We have consecutive wedges, 1, 2, 3, 1, 2, 3, 1, maybe 2, maybe 3. For whatever reason, let me try this. I'm going to delete the chart. Anyways, it's different. One of these bars on my other computer is missing. I think it's the December 26th bar. So December 26th is missing on this chart. But if I go to my other computer, my trading computer, and I look at December the 26th, it is still showing. So it's very odd why that is. But you can't really see it here, but we have a wedge. Anyways, my thought was wedge 1, 2, 3 with nested wedges in each leg. I thought the chances were good we'd sell off to the moving average. The bears, they're trying to make the market always in short and get a second leg down, but we have bad follow through. So it'd be kind of interesting to see what we get here. We're breaking below the neckline of a double bottom here. So it's basically a double top. The bears, they're hopeful they can get a measured move down on the daily chart right here and down to this area, 4,600, or really 4,650. But they really need to get follow through. And I suspect tomorrow will probably disappoint the bears, similar to what the euro versus the dollar did today. First bar of the day, we have a bear bar, and it's a strong enough bar. We'll probably get at least a second leg down. It's accepting the gap down from bar 81. And there's one important thing about the open to bar 1, and that is we're probably going to test down. By the way, I'm looking down and to the left to check my other computer because I have StreamYard running on it to make sure everything's operating properly. Anyways, follow through. Bar 1 is accepting the gap. and that increases the probability we're going to go a little bit lower. While I do think we're probably going to fall, we're probably going to go above the yesterday's low, bar 68. We have the magnet of the December 20th close and the daily chart moving average right here. So the chances are this is close enough, we'll probably get down to it. And then bar 2, we have an inside bar, probably buyers below 2 scaling in lower, but with the gap down, reasonable to expect that we will probably get some kind of second leg down. 3, doji, probably buyers below 3 scaling in lower to retest of the yesterday's 68 low and the bar 1 high. Are we always in short? We probably are with the gap down, but we have a 3-bar tight trading range, and that will lower the probability of traders doing anything right here. 4, we broke below 3, reversed up. You can call it a second entry buy, but look at this. What do you notice? Overlapping bars, bear bar, and then a bull bar, small bear doji, small bull doji. So the market is fairly neutral, and that means it's really low probability to do anything here. Better to wait for the breakout. Bar 5, outside down. You can call it a second entry sell. You can call this the low 1 with 3. And if you include bar 1, it's part of the gap. So bar 1, part of the gap, pull back on 2 and 3, low 1 on 3, and then pull back, low 2 on 4. And then we broke to the downside on 6. But look at the bar. We're reversing back into the range, the tight trading range from bars 1 to 5. For the bulls, they'll see it as a final flag, and they want a reversal up in a test of bar 68. And that's what happened on bar 7. 7, why did it happen? There's often a report at 10 a.m. Central Time, 9 on the open. So in other words, there's often a report on the after the close of bar 6, which is 10 a.m. Eastern Time, 9 a.m. Central Time, which is what I'm in. Then you can see what happened. We rallied above the bar 68 low, the blue line, and then we reversed back down on bar 8. Now, why do we do that? Simple. We had a gap down, and the follow-through selling, although it looked weak right here, it's either going to be it's either a bear trend or a trading range. So as good as this bar looks right here, it's probably still a trading range. There's probably sellers above. Now with the reversal down on 8, this is enough of a surprise. It's probably going to get a second leg down. If I could draw it, I would. But anyways, the point is, if you're a bull and you bought up here and this bar is your follow through, you're trapped. And because of that, you may have more traders selling below 8 than buying. We have an expanding triangle right here. So bar 8, it's an expanding triangle, and that will increase the probability that the market's going to go sideways for most of the day, even if we break to the downside, because the range will probably get smaller, it'll probably get bigger and continue to go sideways. Bar 9, strong enough bear bar that it's a surprise. And look, as strong as it is, you can see consecutive bear bars. We're probably going to get a second leg down and test closer to the December 20th close, which is also the moving average. Are we always in short? We probably are. But with the expanding triangle, there's increased risk that the market is probably going to go mostly sideways here. Yeah, the reason why the sound is better, I didn't realize the microphone that I have that's set up to the Rodecaster was not turned on. It wasn't connected. The StreamYard, excuse me, StreamYard was just using the default microphone on the computer. So that's why it sounds better now. Anyways, 9, strong enough breakout, probably going to get a second leg. But look at the follow through on 10. If you sold the close of 9, ask yourself, are you really thrilled about the follow through on 10? Of course not. And because of that, there's added risk that this could be a failed breakout and lead to a reversal. But it's because of 8 and 9, there's probably sellers above 10 for a second leg. One of the problems with selling the close of bar 9 is it's not breaking out that far compared to this entire range. So it is a breakout bar, and that's good, and it's trapping bulls who bought up here. It's not closing. This bar is mostly overlapping the prior 3 bars. So that increases the probability that we're going to go more sideways. But with the magnet not far below, I expect we're going to get down to the December 20th close. And then you can see bar 11, reversal up, but a weak doji bar, probably sellers above and a second leg down. 12, testing higher, so pulling back rather deep, and the bulls who bought the 7 low and more lower are making money. So that lowers the probability for the bears, but strong enough sell off 8 and 9, second leg down likely, and I suspect we'll get to the December 20th close. 13, doji, probably buyers below scaling and lower. And then 14, you see what happened. The bears gave up, and the bulls gave up, and the bears got a second leg down. Buying below 12 makes sense if you're willing to scalp out around the midpoint of the bar. And that's a tricky trade because the risk reward is not that easy. You're buying the low of 12 here, and your target is around the midpoint of the bar. So your risk is from, let's say, 53 even down to 48. So that's about 5 points. And the best you stand to make is probably 3 points. And that is pretty difficult risk reward. So if you're buying below 12, it's really a scalp at best, and it's not that easy. And you can see what happened with 13. Bulls bought below it. Some of them scalped out. Those that didn't scalp out here, they were disappointed with 13. And what did they do? Their entry price is 53 even, and the high of this bar is 54.50. So they were able to make a 1 point scalp before the market broke to the downside. Other traders, they bought above 11, hoping for an opening reversal at 54.25. Their entry price is 54.50. And look at the high of this bar, 54.50. It touched the 11 high. It touched the entry price of the bulls who bought above the 11 high. 15, bad follow through after 14 at an important magnet, yet the December 20th close and the moving average. I'm going to move, even though it's going to be slightly off. I'm going to put daily EMA is just a reflection that we're near an important price level. 15, bad follow through, but probably a second leg down likely. And you can see we're going a little bit lower on 16. Whenever I'm trading, I like to keep the scaling around the middle. So in other words, I never trade like this, because if you have a bar that's all the way down here, it's really easy to give yourself the false illusion that the market cannot go lower. And the reality is the market can go a lot lower. So I like to keep the scaling at least where there's always room to the downside and the upside. 16, trying to get follow through, but because of 15, I suspect the downside's probably limited. And then 17, a bull bar. So the bears, they got a second leg down after 14 with 16, but a reversal up on 17. And you can see a little bit of an expanding triangle here on a smaller time frame. So we have an expanding triangle from bars 1 to 9, an expanding triangle right here. Chances are this whole thing's probably going to be a trading range. 18, reversal up, strong enough reversal up that I think it's reasonable for the bears. If I was a bear and I was short here, I'd be out of shorts. You're right at resistance. You're right at support. And with all the buying pressure we had on the open, chances are we'll probably reverse back to it. Strong enough bar, 18, we'll probably get to the moving average, go a little bit higher. 19, a follow through bar, but a tail on 18, tail on 19 lowers the probability of traders buying up here. However, the reality is there's probably buyers below scaling in lower, and this whole thing's probably a trading range. But the bears who sold down here and scaled in probably will be able to avoid a loss. Inside bar on 20 increases the probability that the market is going to, it's a possible final flag. It's a triangle, and triangles are lower probability buys below and above. 21, outside bar. It's a flag, but more importantly, it's a 3-bar tight trading range, so probably limited upside. 24 outside down. I suspect the market's going to pull back here, so probably buyers below scaling in lower, but the pullback could be all the way to the 16 high. 16 was a bad buy signal bar above. It's a bear bar, so there's probably sellers above scaling in lower. And because of that, there might be more sellers up here than buyers. But because of this rally, I suspect any bull buying here and scaling in will make money, but they need a wide stop. 23, bad stop entry buy above, probably going to go a little bit lower. 24, we triggered the buy above, but found sellers. And then 25, an inside bar, but probably buyers below, scaling in lower. Although I do think we're going to test a little bit lower, and we may have to test back down the December 20th close, but we may get a higher low instead of a lower low. Strong bear bar, 26, but overlapping most of 25, so probably going to go more sideways. And you can see what happened. We sold off, testing near the high of the bar 16 high of the bar 49.50, which means 49.75 is the entry price, and the low of this bar is 50.50. So we came fairly close to it, haven't quite reached it yet. What about buying above 27? Fairly low probability buy, forcing you to buy in the middle of a tight trading range from bar 20 to 25 or 26. Lowers the probability and probably more sellers above. 27, inside bar, probably buyers below and sellers above, but we may have to fall a little bit lower and get down to the 16 high. There's also bears trying to take profits around the daily close and bulls buying, so it's still probably a magnet. And you can see 27, bulls bought above 27, disappointed 28, getting out break even on 27. What about selling below, getting out break even during 29? What about selling below 29? Some traders will, but really not ideal. 30, bear breakout below 29, but a possible sell vacuum test of the 27 low or down here. There might be more buyers below scaling in lower. 31, reversal up, but fairly tight channel, tight trading range, and forcing you to buy right under the moving average. And because of that, this might be due to bulls buying above 27 and scaling in lower during 30 and getting out around break even. So there might be more sellers above 31 than buyers. 32, bear bar. We triggered the buy above 31 and sold off. What about selling below 32? It's a triangle. It's a tight trading range. I suspect there's probably still traders buying below, scaling in lower. And unless the bears get a strong breakout below the 18 low or the 16 low, probably buyers below in a leg in a trading range. So the bears, they're hopeful they can get this, but chances are they probably will not. 33, weak entry bar. Probably it's a weak entry bar after 32. Probably going to go at least, we may go a little bit lower, but we're hesitating right at important support, the December 20th close. So I suspect the downside's limited. 34, outside down bar. We triggered the sell above 34 and reverse down. But probably buyers below, scaling in lower. And 35, a bull bar. For the bulls, you can call it a parabolic, you can call it a wedge, high or low major trend reversal. It doesn't look like a great buy, but the bears keep trying and they keep failing, and this increases the odds that we're going to reverse up and try and test back to this area, the 24 high, and maybe back to the open of the day or the bar yesterday's 68 low. So if you're a bear, I think it makes a lot of sense to get out of shorts. Bar 30, strong reversal up, probably going to go at least a little bit lower. 36, strong enough bar, second leg up likely. 37, follow through buying. It might be by the close, but it's probably better to wait for one or two more bars. 38, still it's by the close, probably going to go at least a little bit higher, but near the highs of 24. More follow through 39. Possible we may break above the neckline 24 and go a little bit higher to yesterday's 68, bar 68, low. 5 consecutive bull bars, probably buyers below, another bull bar, but an inside bar, so getting overlap. But I expect we'll probably still get at least a small second leg up. Bear bar, probably buyers below, and then we got a surprise on 42. Testing the open of the day, probably going to go at least a little bit higher, but it's still a trading range day. And because of that, I expect disappointment somewhere up here. 43, we rallied and pulled back and tail below the bar, probably buyers below, scaling in lower. And then 44, an inside bar, a reminder. 43 and 44 are reminders that we're in a trading range. So probably buyers below, scaling in lower. 45, we triggered the buy above 44, but I suspect there's more sellers above than buyers. And then 46, inside bar, probably buyers below, scaling in lower, but an overall trading range day. And because of that, we could easily pull back to the 42 low or the bar 24 high breakout point. 47, bear bar, probably going to go mostly sideways here. This does not look like the start of a bull trend. This looks like a rally in a leg in what will become a trading range. And because of that, I suspect we're going to go more sideways here. 48, doji, probably sellers above, buyers below. But my concern with buying is you're buying high in an overall trading range. And then we broke the downside on 49. 50, tried to reverse up, but I suspect sellers above. 51, a pullback for the bears. The bears, they sold off to the 50 low and pulled back. And now 51, low one short, probably buyers below, scaling in lower. 52, buyers below 51, but it may just be a retest of the highs. It's very common for low ones to get buyers below the bar, like 51, but then there's sellers around the midpoint. So if the bulls that are buying, they're scalping out around the midpoint, and then we get a second leg down. 53, bear bar, failed breakout above the 51 high. I suspect we're probably going to go a little bit lower. And because it's a trading range, we could pull back all the way to the 35 high. 54, a bull bar, but a bad stop entry buy. And then you can see we had the FOMC, looks like the FOMC minutes release on 1305. Outside down bar, strong enough surprise we may get a second leg down, but with it being a report bar and an outside bar, we could easily reverse up. And that's what happened on this bar. Typically, it's pretty whenever you have an FOMC release, whether it's the minutes or the meeting, it's typically best to wait for at least 2 bars after the report, because if you're selling the first bar, and especially if it's still within the range, it could easily sell off, test a support level like the December 20th close and the EMA on the daily chart, and then reverse up. What about buying this bar? You can take it for a swing, but it's still a trading range day overall. And because of that, there might be more sellers above. 57, the bears that sold the 55 close and more higher were able to make money. The bulls who bought above 56 and bought more lower were able to make money. And you can see same thing for the bulls here. Bulls buy the 56 high, buy more below 57, get out around break even on their first entry during 58. 59, an inside bar, second entry buy for the bulls. I think the bears probably get out and will probably go at least a little bit higher. And then 60 broke out to the upside, breaking out above 43 and the bar 8 high. But it's a possible second leg trap. Leg 1, pull back, leg 2. And it's a bull breakout, but it's only 1 bar. Better to wait and see what the follow through looks like. 61, doji, disappointed bulls bought the 60 close, may look to get out break even on the following bar. Probably buyers below 61 and 62, but it's a bad high 1, so there's probably sellers above the bar. In 63, we have a bull bar, but it's a bad buy signal bar above 62, so I suspect there's sellers above scaling in. 63, second entry sell for the bears. Possible, you can call it a wedge, 1, 2, 3, or an expanding triangle. Doesn't really matter, but it's more clear a wedge. 1, 2, 3, failed breakout of the 8 high. I think bulls certainly get out of longs below 64. Too much risk we sell off to the 60 low or the bottom of the second leg, bar 59, bar 58, or 56. Weak entry bar for the bears on 65, but probably sellers above 65 for a second leg down. And then 66. Now we have 3 consecutive bear bars, and the follow through is getting stronger for the bears. Probably going to go at least a little bit lower. 67 breaking out to the downside. 68 follow through. And then 69 more follow through selling. Strong enough breakout. First reversal up probably will fail. With the dojis on 68 and 69, we may have to bounce before we get the second leg. And with it being a micro channel, the pullback could be further than what traders want. So we have an 8-bar micro channel. We triggered above the bar, went outside down on 71. And we also have 8 consecutive bear bars. What about selling down here? I think it's better to wait for the pullback. You're still in a trading range, and the pullback could be deeper, much deeper than what traders want. 62, another test of the December 20th close and reversal up. What about selling above 72? I would not. It's a second entry buy with 70. And like I said, the pullback could be all the way up here around 45.57, testing the bar 69 high or the bar 68 high. And that's what happened on 71. 71, strong enough surprise, first reversal down, probably will fail. And 70, I said 71, 73, strong enough surprise, first reversal down will fail. 74, testing the high of 72 and reversed up. And you can see what happened on 75. The bulls who bought the 73 close at 56 and a quarter, the market went up to 56 even on bar 75, not allowing these traders out. Strong enough surprise, 75. We may go a little bit lower. We're testing the low of the trading range, but it's not clearly always in short. Follow through 76, therefore increase the probability that we'll go a little bit lower. We have a possible breakout point gap or a micro gap. Bar 74 high, bar 76 high, bar 74 low, 76 high. And then we got a second leg down on 77, but too late in the day to do anything. What about selling the close 77? I would not, for one, time of day, but also it's a bear break. It's the biggest bear bar in a climactic sell-off, increases the chances that there's buyers down here. And you can see 78 reversed up, and then we went sideways. And you can see on the Globex, we're bouncing. So the market's around the high of this bar. I do suspect we'll probably test back into this range at some point during the Globex session. For stop entries, I thought the first reasonable trade was selling below 8. What about selling below 5? You could take it. My only problem with selling below 5 is it's a fairly tight trading range, and that lowers the probability of selling below it. You're selling in the middle of a tight trading range, really the bottom portion of a tight trading range, so it's really not ideal. We had a bull breakout on 7, reversal down, so it's a failed breakout of the highs of the day, and it's a bad follow-through bar. It's a reversal bar after the bar 7 breakout, so that's a better sell, but the risk is still big selling below 8. And then as far as what else, I thought it was hard to sell below 12 or 13. You could take a sell. You could sell the close of 9 for a second leg down, but not that easy. And then where do you buy? Not really. Really difficult to buy here because it's probably a leg in a trading range. Therefore, you'll get a deep pullback. Selling below 22, not ideal. Selling the bottom of a tight trading range up here. And you can sell below this bar, but you're still selling a breakout of a tight trading range. And if you do, you got to be quick to react. If you get a bar like this, maybe you get out above or you stay short betting on a second leg down. A lot of times if I sell here and the market starts to sell off and it's near support and then starts to pull back, I exit the trade and then I look to sell again on a successful breakout. And then really, if you buy here, what do? If I'm buying, for one, buying above here is buying in the middle of a tight trading range. So it's really not ideal to sell out of longs below 27. There's probably buyers below 27, which means it's not really ideal. If you do buy here or here and you get stopped out, you have to buy again above a bull bar, on which is what you got on 35. If you bought above 27, it's okay to exit on 29. And then you can buy above 35 or you can buy above 36. And then where do you get out? At some point, when the market starts to go sideways, you have to find a place to exit. Maybe you exit a couple of ticks below 48 or below 49, but it's right at the moving average. And then you can see what happened on 50. 50. And then where's the next place? I think you wait for the report bar. I wouldn't sell below that. I think it's okay to buy above that, but big outside, big bear bar, big bull bar, we may go sideways for a couple of bars. If you do buy above it, I don't think you exit below 57. Stop is below 56, or you can wait and buy above here. But then if you're long from up here, I think you have to get out below 64 and bears go short. And then where do they get out? Some of them, I think it's wise to get out a couple of ticks above 72 or above the either a couple of points above 72 or at the high of 72. And then I'd let the rest of this go. Limit orders, lots of limit orders. Buyers below, sellers above. And I thought it was reasonable. You could sell above bars here. You can buy below 20, but it's an inside bar, not ideal. And I thought as far as easy limit orders, not a lot of easy ones. Because buying below the micro channel here, it's forcing you to buy relatively high. You could sell above 44, but tough to do when you see 42 and 43. I thought buyers below 57. I thought selling above 62 made a lot of sense. High one buy after a failed breakout of the high of the day and a second leg trap. Leg one, pullback, leg two. Bar 60 was the second leg trap. And that's probably it for limit orders. But there were a lot of limit orders that I didn't talk about. Buy the close, sell the close. Thought sell the close on 9. Buy the close, maybe buy the close 18, but you're buying a trading range, so not ideal. Buy the close 37, 38, 39. Probably okay, but you got to be quick to make decisions. And then I thought it was probably the next buy the close, sell the close was probably selling the close of 66 or 67. And the reality is you could probably sell the first pullback, but a lot of traders would rather get out on 72, wait to see the rally, and then look to sell again as 75 started to form. Let me take a look at a few questions, and then I'm going to wrap this up. Okay, question. What are your thoughts on selling bar 8 today? I thought it got too big and was in the middle of a tight trading range. Yeah, if you're selling below 8, you are selling in the middle of a tight trading range. So it's a low probability sell, but the context made sense. We failed to break out above the one high. It's following a big gap down, so reasonable to expect a second leg. I thought it was okay to sell there. Plus, if you're a bull and you were long from the bar 7, probably wise to get out below 8. Okay. 9 seemed like rare follow through, but 9 was at the bottom of an expanding triangle, so difficult to sell there. Yeah, and that's what you can see. If you're a bull and you bought the 9 close and you didn't get out on 12, look what happened later. The market got a second leg down, but reversed up on 18 or 19. So your logic is right. I didn't personally sell any of this. For me, I thought we were too close. I thought we were going to get down in the 47, 49 area. But I thought we were close enough that I did sell and I got out around break even or made a small scalp. I can't remember. And then I think my last trade, I think I took 1 or 2 trades here and then I bought somewhere down here. But I didn't like this because the bar was big. I thought we would get a second leg down, but I really didn't want to stay short below the 12 low, the low one. So I ended up getting out and I was trapped out down here. Is it reasonable to sell the 22 high and scale in? Yeah, I'm assuming you mean on 24. I thought that made a lot of sense. You're selling right around the break-even point of bar 8, so I think that's logical. I'm going to answer one more question. Last question. When I trade really small and take 6 to 8 trades a day and scale in, my charges are more than my profits or loss. Is this a problem because I keep entering and exiting, or should I just swing the trade? Well, it's a question of what your commission size is. Obviously, I think it's an issue when commission starts to be more than 10% of your transaction cost of your cost of placing the trade. You always have to measure the cost of your trades. It's kind of like the operational cost of a business. And if it's too much, then that means any small mistake that you make will greatly increase the chances of failure. So ideally, if your commission, I would look and try and make your commission at least 10% or less. 10% is still pretty extreme and not ideal, but that's a lot better than anything above 10% is certainly concerning. And you really have to be, for the simple reason you're dealing with a automatic handicap, if you will. There's probably a better way to state that, but the point is, if you have the higher your transaction cost, the more perfect you have to be on every trade. And if you're not careful, your transaction cost can be so high that any slight slippage or mistake will be the difference between making money and losing money. So where do we go for tomorrow? I think it'll be interesting to see what kind of follow through we get. We're at obvious support and we're right at a double bottom. And the bears, they want to break below it and get a second leg down. But look to the left, small pullback trend. There's probably buyers in this area, and we're probably going to go sideways at least for a couple of legs. Thanks everybody for watching, and I will talk to everybody soon. Tomorrow there will be a review on YouTube, and then Friday we'll be in the trading room. Thanks everybody for listening. Thank you.